I'm here today with Brad Fordham, MD of Santander for Intermediaries, and we're just going to talk a little bit about the mortgage market and some of the issues that are here right now. So Brad, firstly, many thanks for taking the time today.
Welcome, nice to see you.
Much appreciated. Now that Article 50 has been triggered, how do you see the UK mortgage market sort of shaping up over the next couple of years?
What we've seen and what we've read in the press is potentially a period of uncertainty. Whilst, as you say, Article 50, we work through the kind of trade deals and our formal exit of Europe. What it means to the mortgage market is an interesting one. So people prefer certainty for sure, and generally the mortgage market is driven by what people need, and particularly if you look at the four main groups, we'd say first time buyers, movers, remortgagers, and buy-to-let investors. What tenderly shapes that is demand in the market, and what we've seen around demand in the market is probably shaped more by things like tax changes, low interest rates, have probably more effect than what we've seen, I think, generally than you could attribute to Brexit. So I don't think there's much cause for concern generally in the mortgage market. I think we need to watch what happens, particularly what happens to interest rate and potential inflation because of currency fluctuations.
Okay, that's good to hear. And in terms of the current business split for Santander, in terms of how much is going to intermediaries, do you see that sort of split maintaining over the next few years, or do you see the sort of digital challenges coming in and maybe upsetting that split?
For us, intermediary has been for a long time the dominant channel in our business. I think the digital challenge, as it were, and the change that's coming is one that I think digitally technology shapes our lives, and I see no reason to believe why that won't change in terms of people's house owning aspirations and how their mortgage needs are serviced. So I think we will see change. I think brokers are in a great place in that customers clearly want to go to brokers for advice and have that broader view across the whole market. I don't see that changing in the short term. The key thing for intermediaries in this will be to focus on what the customer wants, and the customers will drive this. So if customers want to transact digitally, then brokers are going to need to move into that market. I think digital will be enhancements in the way we work currently and will definitely help us.
In terms of prop fees, then, always a popular and sometimes thorny subject. Do you think they're at the right level for the amount of packaging work that brokers have to do prior to submission to lenders?
So from our perspective, obviously we have changed prop fees and enhanced prop fees this year in Q1. So we announced in January that we're paying prop fees on retention business. Mm-hmm. We also announced in February that we would pay a minimum prop fee on new business of £400 to reflect the work that goes on irrespective of the case size. And also we increased our core range by 1 bp across the DA and the AR market as well. If you look back to MMR was around affordability, and probably there was an increase in the question sets from lenders in terms of what we wanted to know about customers and affordability. In terms of packaging that case, from our perspective, there hasn't been a huge increase in the level of packaging that we require. So, for example, we ask for bank statements on less than 10% of the cases that are submitted. We verify some income automatically via bank account data through credit reference agencies. And therefore, from a packaging perspective, if anything, it's become less. So from a prop fee perspective, our position is we pay for distribution. We don't pay for advice, but we want to try and reflect clearly the amount of work that's involved where we can. And we believe we're paying a fair prop fee across the board in those different areas today. And as I say, the changes that we've made have been well received.
Okay, yeah. Staying with that theme, you're right. The £400 minimum particularly has been well received. Are there any other initiatives that Santander is maybe looking to roll out to the intermediary market?
As I said before, the prop fee changes we've announced, we made some enhancements to the system, introduced our intranet system in January, allowing administration users as well. Pricing, we've had some innovative pricing, I guess. We had a 0.99 rate for 18 months. We've had a market leading 1.23%. So I think pricing will continue to try and be as competitive as we can.
Turning to exclusives in the DA market space, do you think they actually bring value to lenders, or it's mainly a form of substitution?
It depends, John. I think in the DA world, what we're conscious of is not shaping the DA market. So if we launched an exclusive with one particular DA or mortgage club, then I guess there's a danger that all we're doing is moving the business towards that club. What we do use DAs for sometimes in exclusives is to test products and test to see how they're received in the market. So we'll continue to do that where appropriate. Generally, what we've done on the whole is if we do an exclusive in the intermediary channel and it's DA, it will go to all DAs and available through any club. And we won't want to change that significantly in the future.
And finally, does Santander or yourself personally have a view on what interest rates are likely to be over the next 18 months to 2 years?
Santander generally, the view is from our chief economist that our latest forecast is mid to late 2018 is when we're likely to see interest rates rise. I guess it's going to be driven by inflation and what happens with inflation and whether or not, again, currency fluctuations drive an increased rate of inflation, and whether the governor of the Bank of England wants to tackle that by using interest rates as a tool to quell inflation. If interest rates go up and mortgage rates increase, whilst maybe better for lenders generally, a higher interest rate environment, but for consumers and for customers, higher mortgage rates means less disposable income, and I guess that has an effect on the economy as well. So I guess it's a tricky balancing act for the Chancellor. From a bank view, as I say, we're saying kind of mid 2018 is the latest view, but who knows, John? Who knows?
Yes. Well, Brad, thanks very much for your time today, and I'm sure we'll speak again soon.
No doubt. Thanks very much.